Hi everyone, welcome to today's webinar here addressing the COVID-19 financial relief programs. My name is Kyle Roseman and I'm the founder of the Santa Cruz Financial Academy. Here is a place where we help our clients, whether they're small businesses or consumers, create financial models that help them save money, increase their efficiency, and basically combat losses that they're having in their budget. Um, at this time, I'm working with the Small Business Development Council to provide free counseling for small businesses with the federal relief funds that are available. There's two programs, and we're going to be talking about both of them today. Also, I'm a proud member of Think Local First here in Santa Cruz, and I appreciate all the support I get from them. So, moving on, we're talking about two programs currently available. We have the Small Business Administration, their Economic Injury Disaster Loan, and it's different than the new loan that's coming out under the CARES Act, which is called the Payroll Protection Program. So this presentation, we're going to be talking about the differences in both of those and how to use them. I want to strongly urge that all businesses apply for both because they are different and they provide relief for different uses. The Small Business Economic Injury Disaster Loan will be granted up to $2 million, up to 30-year term at 3.5 interest for a profit business and 2.5 interest rate for a nonprofit, and the payments are deferred 5 months. This is something that will be underwritten, and we'll go more in detail about this later, but it's the $2 million. That is going to be something that's analyzed by an SBA rep, and they're going to be looking at your loss and your need, and we're going to be talking more about that in the later part of this presentation. The CARES Act is the Payroll Protection Program. That's a bill that was just put out recently and is now available April 3rd today. This loan will be granted funds for up to $10 million. The term is 2 to 10 years at half a point of interest to 4.0 interest rate. The payments on this will be deferred for 6 to 12 months. There's no collateral necessary, it's unsecured, and there's no personal guarantee. So the Payroll Protection Program differs in a couple different ways from the Economic Injury Loan. Some main ones here, we see that this loan is underwritten by an SBA lending partner, so that means a bank, kind of their normal lending partners that provide SBA loans during normal times. So the loan, although it is up to $10 million, is actually determined by taking 2.5 months of payroll costs and expenses. And so what they're going to do is look at the previous year. You're going to look at your payroll expenses, and you're going to take the monthly average, and you're going to multiply that by 2.5 months. The other thing that's really cool about this loan in particular is that there's loan forgiveness. There's certain expenses that will be used by this loan that will just basically be forgiven, and that's payroll expenses as well as the interest portion on debt, whether that's an equipment loan or a mortgage payment. Rent is also going to be forgiven, as well as utility expenses. So that's the real cool thing that everybody's talking about with the CARES Act program, is this loan forgiveness. So we're going to jump into the bill here and start talking about how it works. And I copied and pasted a lot of sections from the bill so that you can take a look exactly of how it's worded and how it all works. So first, we're going to be looking at eligibility. And what the SBA is looking for, what the federal government's looking for, is they want to see that the business was in operation on February 15th, 2020, and it has employees in which it pays payroll. It has payroll expenses, salaries, payroll taxes, and such. They're also going to be looking at, are there independent contractors involved who are being paid 1099? Basically, when it comes down to it, the required documentation for this loan has to do with payroll. So what are payroll costs? They're defined in this bill. At the top, we see the sum of payments of any compensation with respect to employees. That is a salary or wage, commission, similar compensation, payment of a cash tip or equivalent, payment for a vacation, parental, family, medical, or sick leave, allowance for dismissal or separation. So what that is basically furlough payments or severance pay. Those are expenses that will be paid for under this loan. Also, we see that health benefits are a part of payroll expenses here. Retirement benefits are a part of payroll. Payment of state or local tax, employment taxes. And the sum of any payments that, what it's saying here at the bottom is that anybody who's self-employed, a sole proprietor, independent contractor, they're also eligible to go and apply for this loan. One thing that is not totally clear yet, that I'm still getting clarity on, is for companies that work with contractors, are those contractors supposed to go apply for the loan themselves? Or is it something where the company who is hiring those contractors can go apply and get their wages covered underneath their application? One thing that is for sure is that today, April 3rd, businesses can go apply for this loan. And next week, on Friday, on the 10th, independent contractors, sole proprietors, self-employed individuals can go and apply for this loan. I would imagine that what's happening here, whether or not a contracted employee will get paid by the employer through this loan, has to do with the type of working relationship that they have. Has it been established over the last couple years? Is it a 1099 employee that's been on payroll for an extended period of time? That employee who's contracted on 1099 potentially will probably get paid through that company going and applying for this payroll protection program. Otherwise, if it's somebody who is not necessarily as connected to the employing company, they will probably go and apply for this loan themselves. So we have some exemptions here. Compensation that is over $100,000 a year will not be covered. But I do believe that the compensation of up to $100,000 will be covered. So if there's an employee who's on salary for $120,000 every year, their compensation that this loan will provide for is up to $100,000 of that. Certain taxes that are imposed or withheld under chapters 21, 22, and 24 of the IRS code are not to be covered from this loan. Any compensation for an employee who lives outside the United States is also not covered under this loan. And then any sort of sick leave wages that have already been addressed by some of the relief credit that's already been made available are not going to be covered by this loan. A lot of what this bill talks about is something that they refer to as double dipping. There's a lot of resources that are being available out there, and so there's basically the federal government doesn't want businesses to receive relief for the same expenses. And so we'll be talking about that more later in this presentation as well. So then there's also allowable use of covered loans. So basically what's going to happen here is when you apply, you're going to apply for an amount that is equivalent to 2.5 months of payroll costs. However, you can actually use this loan to pay other costs as well. So we see here that allowable uses are payroll costs. We know that costs related to continuation of health benefits. We know that employee salaries and commissions. Other allowable expenses on this loan that were not defined as payroll expenses are payments on the interest portion of any mortgage obligation, as well as other debt obligations, equipment loans, etc. Rent is also covered. It's an acceptable expense that will potentially be forgiven. Utilities as well are also an acceptable expense. So there's this clause in here in the bill that talks about refinance. And what they're talking about here is basically if a company has already applied for an economic injury loan and they've been granted that loan, a lot of what was happening earlier is that the economic injury loan was covering payroll costs. So if somebody did go and get a loan for payroll costs, they can refinance that loan into this one. The reason being is because the economic injury loan is not forgivable. This loan is forgivable. So if you did apply for relief in the past and you got it, like within the past 4 weeks, and you used it for payroll, then you could potentially roll that into this loan and it could get forgiven. Right underneath that, it has this portion where it talks about non-recourse. The administrator shall have no recourse against any individual, shareholder, member, or partner of an eligible recipient of a covered loan for non-payment of basically any acceptable expense. So business owners are off the hook basically for this. It's non-recourse. It's not personal guaranteed. It's not collateralized. And then we have this thing about forgiveness, which is obviously really cool and really exciting. It's a little bit of the bittersweetness of this entire pandemic that we have going on. So forgivable expenses are payroll costs, any payment of interest on any debt, whether it's mortgage or equipment. And so, one thing that's not forgivable is prepayment of a loan or principal payments on a loan. Other payments that are forgivable too is you can use this money for a rent obligation or utility payments such as water, gas, electricity. So we kind of have this good faith agreement here. That first clause is basically saying that this loan is to address the uncertainty of the current economic conditions that we're in, and to support ongoing operations through this time. The second one is acknowledging that the funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments. The third one is the eligible recipient does not have an application pending for a loan under this subsection for the same purpose. So they're talking here again about double dipping. They really want to make sure that businesses are not applying for relief funds for the same expense multiple times over. And then it kind of, number 4 here, it goes again into double dipping. That the eligible recipient has not received amounts under this subsection for the same purpose and duplicative of amounts applied for or received under a covered loan. Now, that is also Again, it goes to double dipping, but the one thing that we do know is that if a company did apply for the economic injury loan to cover payroll costs, that loan can then be covered and rolled into this loan and be forgiven. So that's kind of the way the two programs are they kind of have this merging effect. Whereas if you did get an economic injury loan and it covered the same things that CARES Act is intended to cover, that you can refinance that loan into this one because this one is meant to be forgiven. This is something that I wanted to talk about because a lot of funding is going into the small business development centers as well as other people who are being referred to here as resource partners. But really what I want to talk about is small business concerns. Now, this is going to come up later. These concerns are not addressed in the payroll costs, but are something that might be addressed through the economic injury loan. So small business concerns are defined in section 1103, entrepreneurial development. And what they're talking about is any disruptions in supply chain. And then they talk also about staffing challenges, decrease in revenue and sales, a closure, stuff like that. But what's really cool here is any disruption in a supply chain. This is a stated concern by the federal government, and is something that the administration is doing the best they can to address. And so we just want to keep this in mind, and we'll come back to it later. So to summarize the CARES Act, this loan is underwritten by an SBA lending partner. That's a bank or financial institution that has already had a relationship with the SBA and is making small business loans already. The loan amount is equal to 2.5 months of payroll costs. There is an element of loan forgiveness. And the practice of CARES Act is still subject to interpretation. What I mean by that is basically you're going to be working with a bank lender. And so we can sit here and go through the bill and talk about everything. But when it comes down to it, you're going to be working with the bank to really talk about, the actual process and how much you qualify for. So I want to move into the economic injury disaster loan because this is different and it covers a different need. And what the really interesting conversation to talk about is how these two resources can be used together really to address the overall business needs of our current dilemma. So once again, this loan is written for up to $2 million at a 30-year term, 3.75 interest rate for for-profit businesses, 2.5% interest rate for nonprofits, and payments are deferred for 5 months. The main difference in the two programs are in the underwriting experience. Also, the injury loan will not be forgiven, but what I'm talking about here in the underwriting experience is that this loan is underwritten by the SBA itself, and the requirements are a little bit different. So the CARES Act, we're looking at a specific thing, 2.5 times the average monthly payroll. That's kind of what we're looking at here as far as how much money we can receive. In addition to that, this is kind of where the interpretation comes in, where you'll be working with the bank, is are you rolling in a previous economic injury loan into this package? That's something you'll be working with the lender on. So the economic injury disaster loan is based on the economic loss. And what's really interesting about this is that this is something that's going to be determined by the SBA representative. This is the loss, as far as what I've been able to get my hands on right now and the trainings that I've been taking in order to provide this service. What I can see is that there's not really a concrete definition of an economic loss like there is payroll costs. The loss is really something that's defined by the SBA representative that you'll be working with. And that's why I start talking about these small business concerns, because this is something that is brought up by the bill itself. The disruption in supply chain. And so this is where things get really kind of creative, and we kind of have to just stay tuned to see what's possible here. But I want to make sure that every business is really applying for both types of relief. Your business may have experienced a loss not coverable by a payroll protection program, meaning you went and you got the CARES Act loan, but you have a loss that goes beyond that. For this reason, it's my recommendation that you apply for both programs. Now, this is not to be mistaken with double dipping. This is to cover unforeseen expenses due to change in operations as a result from COVID-19. And so this is kind of the creative idea of, well, what's going to happen if there's basically like a retail store that has operated from their brick and mortar location the entire time they've been in business. Let's say there's a skate shop. Now, they're concerned that they're going to have to be closed for the entire summer. This is a loss. Is the expense that they now have to take on in order to make a change, in order to build out an e-commerce website and take their revenue generation online, they're going to face an expense there. Can that be defined as a loss? I believe what's going to happen here is that it comes to packaging your proposal and how you tell your story, because that loss is going to be defined by the SBA rep. And we're kind of have yet to see exactly how they're going to react, right? So every industry is unique. Every business is unique. Every business will be affected by COVID-19 differently and will respond differently. And the expense of that respond might be considered a loss by the SBA, and there's really no harm in applying for this loan to kind of see what happens. Again, the economic loss is determined at the discretion of the SBA representative and is not in concrete terms. It's not spelled out the same way that the payroll costs are spelled out in the bill. We shouldn't speculate the decision of the SBA lender. And what I mean by speculate is we shouldn't turn our cheek to what might be a possible opportunity. We should be optimistic and we should be patient. The underwriting methodology of the SBA goes like this. They're going to look at the loss, they're going to look at the need, and they're going to look at the capacity. So the loss is the impact on revenue because we had to temporarily shut down our business. We had to close our doors and we had to shelter in place. A few weeks ago, I held a webinar, and this is what we were looking at as defining our needs. We were concerned with payroll. We were concerned with money that we owed our vendors. We were concerned with debt finances. And really, our need was kind of looked at this. What expenses will not be met due to loss? Today, with the signing of the CARES Act bill, there's kind of this redefining of your needs. This is a possibility. Expenses endured due to operational changes in response to the business concerns defined in Section 1103. Again, we kind of just have to see what the response is and how this bill is going to trickle down into the actions of the SBA. And we're not certain, but really I want to push all the small businesses to take this time to be creative and understand that resources are out there if you do have to be creative, if you have to be innovative, and you have to make changes in your business operations because of COVID-19, this might be something that's considered a loss by the SBA, and you should be open to the fact that you can receive funds to do this. And why is this important? Well, this is important because the terms of the economic loss loan are terms that we will never see in a typical normal operating time. Usually you're not going to have a 30-year term. Your interest rate's going to be around 9%, more or less. But to get the same rate you would on a home mortgage, for example, to use funds with the same terms as that in order to grow a different stream of revenue within your business, we're not going to see that ever again. And that's why I'm kind of saying, hey, look, we should really be applying for both. And again, this is not double dipping. This goes beyond the scope of the payroll protection program. Capacity is the other thing they're going to be looking at here. The existing revenue under normal operating conditions. Is it enough to service the debt that they give you? Does your capacity meet your need? Does our revenue under normal operating conditions allow enough cash flow to support a loan at 3.75% over a 30-year period? So when we put this in perspective, for example, if our need is $100,000, does our normal operating revenue allow for a cash flow burden of $463 per month? Now remember, this is also going to be pushed off for 5 months. So once your business goes back to operating capacity, is it going to be able to support that debt service? We should allow the situation to unfold, complete the application process, and see how the SBA responds. Everything is still unfolding. Everything is so new, and everybody's really scrambling together to create a response. Really, we need to be patient with what's happening, and we really need to be focusing on what changes do we need to make in our business in order to survive this thing. The money is there, and we should all be confident that the money's there. We just have to apply, kind of sit and wait, and then strategize on how we can get our business to survive the coronavirus pandemic. That's really what we should be thinking about, because I just want to stress that the money is there. It's available. And people like me working at the Small Business Development Center are here to help you go through the application process. And it should not be a concern of whether or not you can get the money. Really, what I'm seeing is the concern is, how are we going to use it to grow our business? How are we going to use it to address the changes we need to so that our business survives? The purpose of the SBA Disaster Relief Loan is to support the continuous trade of goods and services, to support back-end operations of a business, to prevent bankruptcy or permanent shutdowns that would not have occurred otherwise. Again, this is something that I pulled from the webinar that I did a few weeks ago. And now what I'm kind of proposing this question of, is the purpose of the SBA Disaster Relief Loan to ensure the survival of small businesses? I believe so. And so that might include expenses that the business endures as they respond and adapt to operating differently in today's economic climate. So let's work together to tackle the challenges that we're facing today. Feel free to reach out to me. This is my contact information. My website is livefinanciallyfreetoday.com. You can email me at info@localecon831.org. My number is 831-331-1977. And there's a lot happening right now, but you could probably get a hold of me through the SBDC website. But if you're watching this video, you're probably on my website right now, and feel free to reach out. I'm really looking forward to helping businesses strategize, be creative, and get through this whole thing. So with that said, have a great day, good luck, and fill out your applications. I'm going to be putting up some more videos that are going to go step by step through the actual application paperwork. Again, remember, the money is out there. It's a matter of how we use those resources in the most efficient way and create, reestablish our revenue stream as a business. So, all right, have a great day, and thank you for watching this.